The autumn budget is just weeks away and the stakes could not be higher. Chancellor Rachel Reeves is under intense pressure to fill a multi-billion-pound gap in public finances. But there's one major constraint she faces: her own fiscal rules. Those rules mean debt must be falling as a share of GDP, and that limits borrowing. So, when borrowing isn't an option, only one path remains: taxation. There's growing speculation surrounding this budget. We've seen reports and leaks, and governments sometimes leak potential tax changes to the press deliberately to test how the public reacts. At this stage, even with the Treasury, some of the decisions aren't finalised. Much of what we're hearing remains speculation. But one thing is certain: tax rises are coming. Even though, after last year's budget, Rachel Reeves repeatedly assured the public that Labour would not be coming back for more.
We won't see another big tax and spend budget like this unless there's some kind of global shock and you have to react. But absent some kind of set of disastrous events you can't control, this is the big reset.
But this is it. This is the first budget of this Parliament, and we had to reset. We had to wipe the slate clean. We had to bring out into the open all of the previous government spending commitments.
Because a lot of people are saying you're going to do the same next year and the year after.
No,
and you're
absolutely
saying
not. No, we have now set the public spending envelope for this Parliament. We don't need to come back and ask for more.
Rachel Reeves said after the 2024 budget that she won't have to do a budget like this ever again.
We've put our public finances back on a firm footing, and we've now set the budgets for public services for the duration of this Parliament. Public services now need to live within their means, because I'm really clear I'm not coming back with more borrowing or more taxes. And that is why at this budget we did wipe the slate clean to put public finances and public services on a firm footing. And as a result, we won't have to do a budget like this ever again. And indeed, unlike the last government, I will only be doing one budget a year so that this government can focus on what our number one priority is, and that's growing the economy.
The reason Rachel Reeves felt the need to come out after the 2024 budget and clearly state that Labour would not be coming back for more tax rises is because that budget was enormous. One of the most significant tax-raising budgets in modern British history. It introduced sweeping changes that affected businesses, investors, and everyday savers alike. And the reaction was fierce. There was a tremendous amount of backlash from economists, business leaders, and the public, who argue that the scale of tax hikes could stifle growth, discourage investment, and squeeze already struggling households. It wasn't just the size of the tax rises that shocked people. It was the sense that Labour had gone further than many expected. While the party had signalled in its manifesto that higher taxes on wealth and capital might be necessary, few anticipated the extent of the increases unveiled in 2024. The measures went well beyond what was originally outlined, leaving many to feel that Labour had broken its own mandate, and prompting Reeves to reassure voters that such a heavy tax-raising budget would not be repeated.
And so as a result, we did need to raise taxes in this budget to put our public finances on a sound trajectory.
Of taxes. It's the biggest tax-raising budget since 1993. It's gigantic. And you said before the election no plans to raise taxes, or the PM did, beyond the $8 billion that you had earmarked. So a lot of people out there are going to be quite shocked today.
Well, in the decisions that we've made in the budget today, I accept that this is a big and a substantial budget.
But
it wasn't the budget that I was.
It wasn't the budget straight with them.
It wasn't the budget that I was expecting to deliver when I became Chancellor.
Now, a year later, a budget of similar scale to the eye-watering £40 billion tax-raising budget of 2024 appears to be on the cards for the 26th of November budget. Even though the Chancellor stated after that budget that she won't have to do a budget like this ever again. So, the big question is, where will Labour strike next? Your savings, your property, or your pension? Let's start with property taxes. The area causing the most nervousness around Britain right now. There has been mounting speculation over recent months that Labour may reform property taxes. Some suggest the government could replace stamp duty with a new property tax paid on sale or annually. Reports from several media outlets in August indicated that the Treasury was considering a national property tax paid by owner-occupiers on homes worth more than $500,000 when they sell. If implemented, this would be one of the biggest changes to the property tax system in decades. UK house price growth slows as buyers show caution before budget. The article goes on to state, there is some evidence that buyers are holding back before Rachel Reeves' budget on the 26th of November, a month later than last year's set-piece fiscal event. The Guardian reported in August that the Chancellor was considering replacing stamp duty with a new levy on the sale of homes worth more than $500,000. These headlines show the scale of uncertainty in the property sector. Developers, buyers, and investors are all holding their breath. Another headline summed it up perfectly. Barrett and Redrow warns of budget uncertainty affecting property market. But what's fueling all of this speculation? Part of the reason is timing. This year's autumn budget, scheduled for November the 26th, is unusually late, and that delay has created a long window for economists, think tanks, and journalists to fill the gap with predictions and analysis. The longer the wait, the louder the speculation, and that speculation is already starting to affect behaviour in the real world. Another area being looked at is inheritance tax. Now to inheritance tax, IHT, a subject that hits close to home for millions. Currently, inheritance tax is charged at 40% on estates worth more than $325,000 per person, or up to $500,000 when including the main residence nil rate band. Anything above that threshold is taxed heavily. Although IHT was originally intended to target only the very wealthy, rising house prices have pulled far more families into the tax net. There is speculation that Labour could go further. Insiders have suggested that the government may extend the IHT gifting rules to raise more revenue. One idea being floated is to extend the period donors must live after making a substantial gift before it falls outside their estate for IHT purposes, from 7 years to 10 years. There are also rumours of introducing a lifetime cap on the total value of gifts that can be made tax-free. If implemented, this would make it much harder for families to pass on wealth during their lifetime without triggering tax consequences. Critics argue that this would disproportionately affect middle-class families who have most of their wealth tied up in their homes, not in offshore accounts or investment portfolios. Moving on to the capital gains tax. Capital gains tax, or CGT, is another area where change is expected. There are ongoing rumours that the government could align CGT rates with income tax bands. That would mean that the basic rate could rise to 20%, while the higher rate could go up to as much as 45%. The aim would be to make the system fairer by ensuring those who earn from investments pay similar rates to those who earn from wages. However, it's worth noting that Labour has already raised CGT once. In the 2024 autumn budget, announced on the 30th of October 2024, Rachel Reeves increased CGT rates for disposals made on or after that date. The main rate for most assets rose from 10% to 18% for basic rate taxpayers and from 20% to 24% for higher rate taxpayers. Despite those changes, further increases are still being discussed. Critics warn that continual hikes risk discouraging investment and entrepreneurship. Business owners selling their companies or families selling property could end up paying far more tax on the same transactions. Let's now look at ISAs. According to The Times, Rachel Reeves poised to slash the cash ISA allowance in half in her budget next month. The report states, The Chancellor is again considering slashing the cash ISA allowance for savers in her budget next month. Rachel Reeves, who wants to get more savers investing instead of saving in cash, shelves plans to cut the £20,000 limit in July, following a backlash from banks and building societies. But it is understood that she is now looking at it once again, with plans to limit the amount of the annual £20,000 allowance that could be used for cash, potentially halving it to £10,000. You could still be able to save the full £20,000 in a stocks and shares ISA. This revelation reignited debate about whether the government should be encouraging savers to invest more heavily in the stock market. This is not the first time speculation regarding the ISA allowance has surfaced. As far back as March the 1st, The Guardian ran an article titled "Cash ISAs, Pressure Grows Against Rumoured Move to £4,000 Allowance." This article, published back on March the 1st, stated, "Last week it emerged that ministers are considering a proposal to cut the maximum amount that people can put into them from £20,000 a year to £4,000. This speculated cut spread quickly and caused widespread alarm. Savers across the country expressed outrage at the idea of such a dramatic reduction. Financial experts questioned the wisdom of punishing those who had been disciplined enough to save. The backlash was immediate, and while the government never confirmed the proposal, the public reaction was enough to make officials tread carefully. Throughout the year, strong rumours surrounding changes to the cash ISA persisted. Each new report sparked another wave of debate. Banks and building societies warned that reducing the cash allowance could undermine financial stability by discouraging saving and reducing the pool of deposits that lenders rely on to issue mortgages. Finally, pensions. Pensions are another area under scrutiny. They represent one of the government's biggest tax expenditures. Pension tax relief costs the Treasury tens of billions every year, according to HMRC. In 2022-23, HMRC estimated that pensions received £70.6 billion of tax relief. In the same year, the government collected £23.8 billion in tax from pension schemes. HMRC estimated the overall cost of pension income tax and national insurance contributions, or NICs, relief to be £48.7 billion. That's a huge number, and one that any chancellor looking for revenue will find difficult to ignore. Rumours suggest that Labour could change how pension tax relief is structured. Proposals reportedly under consideration include reducing the tax-free lump sum from the current 25%, which is capped at £268,275, including a flat rate of tax relief on pension contributions for all taxpayers, lowering the annual allowance for pension contributions. Speculation about the tax-free lump sum has been a recurring theme over the years, but has been much stronger recently. If that happens, those with larger pension pots could face new limits. So, what should I do today? With so many rumours circulating, from ISA cuts to pension changes, it's easy to panic. Many savers are now asking the same question: what should I do today? The truth is, it's impossible to predict the future. Every year, in the run-up to a budget, the same thing happens. Leaks, headlines, and speculation flood the news. But it's highly likely that some, if not most, of these predictions will never materialise. That is why experts urge people to stay calm and avoid knee-jerk reactions to speculation. Acting on rumours can sometimes do more harm than good. Imagine taking drastic action, like pulling money out of a pension or shifting investments, only to discover that the change you feared never happened, leaving you worse off in the long run. For example, in the 2024-25 tax year alone, £18.8 billion was withdrawn as tax-free cash, a staggering 61% jump on the previous year. And that spike was fueled largely by speculation ahead of the 2024 budget. But pension specialists warn that decisions driven by fear can have lasting financial consequences. Once funds are withdrawn, they lose the benefit of tax-free growth, and anything above the 25% allowance is taxed as income, potentially pushing people into higher tax bands. It can also restrict how much can be paid back into a pension in the future, and even affect eligibility for certain benefits. It's worth remembering that if major changes are introduced, the government usually provides transitional protections, allowing savers time to plan, to seek advice, and to act on confirmed facts rather than rumours. So, the best thing you can do right now? Stay informed, stay calm, and don't rush into big decisions based on speculation. Keep an eye out on the facts when the Chancellor delivers the autumn budget on November the 26th, because that's when we'll know exactly where Labour plans to strike next. The next few weeks will be crucial. Every decision Rachel Reeves makes will shape how millions of Britons save, invest, and retire. The autumn budget could redefine the financial landscape, from property pensions, ISAs, to inheritance. Like, comment, and subscribe for more updates as the autumn budget approaches.